Hey guys, Steve Ferguson here, your modern mortgage loan advisor. There's a lot of communication and talk going on out there right now regarding interest rates and what's going on and why are they going up and the Fed just lowered their interest rates. And I want to give you guys kind of the Cliff Note version to have a better understanding of how interest rates are derived and what to expect as we continue to move forward. Now, this is not going to be that hour-long video where I get into all kinds of graphs and nitty-gritty details. There's a lot of great videos on YouTube you can watch about that. This is designed to give you enough to make you dangerous and to have a pretty good understanding of what to expect in the future of rates. So let's start with some definitions. Now, I'm looking at another screen that I have on my computer because I want to read a couple of things to you guys. So let's define what the federal funds rate is, which is that Fed rate that we've been talking about. So the federal funds rate is the interest rate at which depository institutions, that's like banks, like Bank of America, Wells Fargo, lend reserve balances to other depository institutions overnight on an uncollateralized basis. So let's say I'm Wells Fargo and you're Bank of America, and I've got an extra couple $100 million laying around that I need to do something with, and you need the money to lend out. I can loan it to you for a 24-hour period of time, like overnight, to take care of any collateral that you have. And it's uncollateralized, which means I'm not making you give me some of your banking locations to collateralize the money, right? So I'm loaning that money to you at the Fed fund rate, okay? And then you guys give it back at, when you're done with it or within the 24-hour period of time. So that's the Fed fund rate. That's all it is bank-to-bank lending overnight. And so then what happens is as those banks get those funds and they borrow them, then they mark those interest rates up to then lend it to the general public. So for example, if you went and got a car loan, they're going to mark up whatever Fed rate they received on their money, because that difference, which is called rate arbitrage, is the difference between what they borrowed at versus what they're giving it to you at, is where banks make money. And they're very profitable at it. That's why you see banks on every corner. So that's how the Fed rate works. Borrowing money, marking up money to get a specific interest rate. Now, I'm going to give you the definition of something else that's really, really important right now when it comes to mortgage interest rates, and that's inflation. So the economic version, our definition of inflation, is a general increase in prices and fall in the purchase value of money. So let me give you an example of what that means. If you were trying to buy a loaf of bread today and the inflationary numbers were low, that means the value of $1 is high. That means you can buy a loaf of bread for like $1, okay? But as inflation grows, it gets higher. That means the value of $1 reduces. So now that bread may cost $1.50, and then $2, and then $2.50. You see what I'm saying? So we don't want high inflation because that makes that our hard-earned money worth less, okay? And so how do we keep inflation from going crazy? Well, what happens is you have to increase the cost of funds, interest rates, to reduce buying. Okay, we need people to buy less. So if we're going from basic economics, we're looking at demand and supply and demand. Okay, when you have a ton of demand in whatever it is you're buying, the people with the supply can charge whatever they want to for it. Versus if you got a ton of supply with not a lot of demand, you have to mark those prices down to get it off your shelves. Right now, from a mortgage perspective, you've got inflationary numbers that are very high, which means that you have to make the price of that product higher to prevent people from buying it, because that should shift inflationary numbers and move them down. Right now, I can say that that's probably the #1 impact influencing mortgage rates is inflation. Now, there's other things that you can look at. I'm going to go over those here in just a second, but I want to be very clear on the basics of where we start. This is where it is, okay? Now, as long as inflation continues to increase, you're going to see mortgage rates increase. So let me give you an example of what's going on with inflation right now. And I'm looking at a graph on my other screen. And this is not information that you guys need to have in front of you. I just need you to get the basics of this. If you remember, back in August and September, rates came down for a minute. And the reason for that is because, like in July, inflationary rates were 2.9%. And then in August, they went to 2.5%. So we're starting to come down. That means rates work in conjunction with inflationary rates. So if inflation goes down, rates go down. Okay, if inflation goes up, rates go up. All right. August it went to 2.5, and then September at 2.4. We're moving in the right direction. We're getting better rates. And then October hit, and the interest rates went up in October because the inflationary rate went from 2.4 to 2%, 2.6, excuse me. And then November it did it again. It went from 2.6 to 2.7. We're going in the wrong direction. So even though the Fed lowered their interest rate, which again is the interest rate that banks borrow from each other, mortgage interest rates went up, and that's because inflation went up. Okay. Now there's other things that affect mortgage interest rates. Job reports. So for example, if the economy is expecting, 260,000 unemployment claims, and we get 270,000 unemployment claims, and that means the economy is worse than we predicted. That could drive rates down. Okay. So there's also a consumer sentiment report. How do consumers feel about the economy? Are they feeling positive, like the economy is getting better? Do they feel like the economy is not good? So there's lots of different reports that exist out there that have moderate, hits to mortgage interest rates, and they can have some basic factors that go into that. But the big stuff is jobs, the housing sector. So for example, how many houses have been being built? How many have been sold? Inflation, in my opinion, right now is number one. And then the Fed rate historically has been a pretty good indicator of where rates are going, but it is not doing any good right now because the inflation number went up. Okay. So you have to remember there's kind of a pyramid here. At the top of that pyramid is inflation. Everything below it could be good or bad, but if that inflation number is still up, we're going to have interest rates stay high or increase. So we've got to get that inflation number in check because you and I don't want to be paying $5 for a loaf of bread. So important information there, right? Now, what we also have to understand from a mortgage rate perspective is where do we think rates are going to go? Historically speaking, when you have a new president coming into office, which we have, you can generally expect most people to get relatively excited about the economy if it's a Republican getting elected. And I'm not trying to be political here, but I need you to understand that when you're looking at Republicans versus Democrats, Republicans are usually more business friendly. Democrats are more government friendly. So Democrats tend to spend more money in the government side, and the Republicans tend to spend less money on government and push more towards the economy. So that makes the economy usually stronger on the Republican side and the government stronger on the Democrat side. So what that means is if the economy is going to get better, right, which it potentially could be, hopefully we'll see inflation start to shift. We'll see what happens there. If the economy is too good without inflation starting, then you can get super inflation, which happened back in the 80s when rates were like in the 15% range. It was crazy. So you got to be really careful. And the Fed is really important to making sure that they control checks and balances on that process. So they raise interest rates or lower interest rates in order to keep this inflation within a reasonable number. And right now, that's just been a roller coaster ride. They haven't figured it out yet. And the reason I don't think they figured it out is there's some politics involved instead of just using true economic numbers. Okay. So when that new president takes office, he's going to do or she's going to do certain things that influence the economy. What I'm thinking is going to happen is in the next 12 to 18 months, you should see the rates on a general decline. I don't think we're going to see a huge shift. I think we'll see a general decline over 12 to 18 months because you've got to give time for this inflationary stuff to work itself out. The new president to come in and put in all their policies and see what happens. So 12 to 18 months from this video coming out should have better interest rates. I don't think we're going to see the bottom of the market for now, probably 18 to 24 months. That should end up somewhere, my estimates, low fives, maybe high 4% range. That's considered a healthy interest rate for mortgage rates. It's somewhere right in that low 5% range. So if it's higher than that, I mean, that's not bad. Like, for example, if you look at the history of interest rates, I think the average interest rate since rates have been tracked is like 7.25, which we're about right there right now. So we're about average, but it's always good to be below average, and hopefully we'll get that way in the next 12 to 18 months. The key for you guys watching this video is, all right, if I'm looking to buy a house right now and I'm trying to predict where my rates are going to go, the best way to do that is to talk to a professional like myself. But if you don't want to talk to somebody, watch inflationary rates. You can Google search today's inflation rate, or you can Google search, inflation graphed over the last 12 months, and you're going to be able to see that information, and you're going to have a pretty good idea of what rates are probably going to do. The important thing when you're shopping for a home is to understand that interest rates are temporary. You can refinance your mortgage as many times as you want to when you own your home, but you can never change what you pay for the house. So remember, when interest rates are high, the demand for mortgages is low, which means that you as the buyer, assuming you're the buyer, have more opportunity or a better opportunity to buy a home for less money than you could before. And you can never change that. Once you pay for it, it's done. That price is never going to change. But you can take advantage of those low purchase prices right now. And then we can help you refinance in 12 to 18 to 24 months when those rates settle out. And now you're not competing with everybody else that just dumped into the market because the rates got low. So if I had any recommendation to you from an economic standpoint, I'm a big fan of buy low, right? Which is now's the time to buy low, and then leverage interest rates as time goes on with the market using refinances to get there. It just takes you out of that competitive pool where, you've got 5 different offers on a house and you're driving that home price higher than it needs to be. So it is a great time to buy a home, in my personal opinion. Now you need to do your own research. It's important to understand what you're buying and what you're getting and what you're paying for it. But with this information that we talked about in this video today, you should have a pretty good understanding of what's going to drive interest rates. Now, please keep in mind, this is kind of interest rates 101. There's a lot more information behind it, and that's where an expert can come and help you. But at least you've got kind of a guiding principle of, you know what, if the inflation rates are going up, even though the Fed is saying this, chances are rates may go up here in the very near future, right? I promise you that from an economic standpoint, the economy is better as a whole when interest rates are lower because mortgages account for about 18% of gross domestic product in the United States. That's a big chunk. So everybody wants people buying and selling and refinancing homes because it helps the economy as a whole. But we've got to get past some of this inflationary stuff first to make sure that that's hammered down, good to go, solid as a rock as we continue to move forward. Now, I need a favor from you guys. Do me a favor, drop some comments on this video. Was this helpful to you? I was talking to my wife earlier today. I'm like, does this make sense? I want to make sure that this is clear to you guys and you've got enough information to make you dangerous. And then ask any questions in the comment section that you'd like to ask. I'd be happy to answer those for you personally. And then reach out to me. My contact information is all over my channel. Love to visit with you guys on a one-on-one basis and make sure that you guys are set up individually for success. No matter what state you're in or where you live, I want to make sure that you have the data that you need in order to make great decisions and find a product that fits for you and your family. As always, I appreciate you guys tuning into this channel. Please feel free to share this information with anybody that you know that needs this data, and I hope it was helpful. All right, guys, have a great day. We'll talk soon, and don't forget to like or subscribe. All right, talk to you later. Bye-bye.